Hello, everyone, and welcome to Financial Accounting. Today, we continue with the topic, the accounting cycle, accruals and deferrals. In this video, we will cover accruals, including accrued revenue and accrued expenses. We will also look at the matching principle and materiality concept and review the effects of the adjusting entries on the balance sheet and income statement accounts. If you haven't had a chance to watch the first part of the accruals and deferrals video, which covered deferrals, the link is right here and in the description box of this video. One of the keys to understanding the accrual of expenses is to realize that an expense has been incurred in the current accounting period, but will not be paid until the following accounting period. Let's look at an example. You may purchase gasoline from the local service station using a credit card. You have incurred the expense for the gasoline, but haven't recorded the cost. You probably will not record your expense until the following period when the credit card statement arrives. Companies cannot follow this practice because expenses would be recorded in the wrong accounting period and thus violate the matching principle. The adjusting entry required is to debit or increase an expense account and credit or increase a liability account. Almost all expense accruals will require this type of entry. Some common accrued expenses include interest owed on loans, wages and salaries owed to employees, and property taxes owed to the local authority. Let's look at an example of accrued wages. Web company pays its employees each Friday. Assume that the end of the current month is on Wednesday. There have been 3,000 in wages earned by Web's employees from Monday, May 29th through Wednesday, May 31st. Let's prepare the adjusting journal entry required of Web on May 31st. The wages earned by employees during May will be recorded in the proper period. Web will debit an expense account, in this case, wages expense, for 3,000 and credit a liability account, in this case, wages payable for 3,000. We know that expenses are increased by debit and liabilities are increased by credit. The balance in the wages payable liability account is $3,000. It will appear on the balance sheet of Web at May 31st. The wages expense account will be increased by 3,000, and this amount will be included on May's income statement. $2,000 of wages were earned by employees on Thursday, June 1st, and Friday, June 2nd. Let's look at the entry Web will make on payday, Friday, June 2nd. Keep in mind that part of the $5,000 of total wages expense has already been recognized. Wages expense should have a debit for $2,000, the portion of the total payroll applicable to June. Next, eliminate the wages payable for $3,000. The balance in the wages payable account is now $0. Finally, credit the cash account for the full cost of the payroll, $5,000. Now let's move on to accrued revenue. A revenue accrual is necessary when revenue has been earned in the current accounting period, but the cash will not be collected until the next period. Examples of revenue accruals include interest earned on investments or loans made to others, and work completed but not yet billed to the customer. In the adjusting entry, we will record a receivable, an asset account, usually called other receivable, and recognize the revenue earned by increasing or crediting an appropriate revenue account. Let's look at another example. Webb has deposited at a bank in an interest-bearing account. Interest is paid by the bank on the 15th of each month. The end of Webb's accounting period falls on January 31st. From the 15th of January until the 31st, Webb earned $170 on its account at the bank. Let's make the adjusting entry to recognize the interest earned from January 15th to January 31st. Webb will increase or debit the asset account, interest receivable, for $170 and increase or credit the revenue account, interest revenue, for the same amount. Just a reminder, revenue is increased by credit. The asset, interest receivable, will appear on Webb's balance sheet at January 31st. The interest revenue account will be shown on Webb's income statement for the months ended January 31st. Webb earned an additional $150 from the 1st of February until the 15th, when interest was paid. Webb will receive a total of $320 on February 15th. Remember that part of the $320 has already been recognized as revenue, so you cannot record it as revenue again, as you will overstate your revenue for the month of February. To record an adjusting entry, debit the cash for $320, as this is how much you received from the bank. Next, credit the interest revenue account for $150, the amount earned during the month of February. Finally, eliminate the interest receivable account for $170. You decrease the interest receivable account because the cash has now been received. Let's look at one more example. A corporation must pay income tax on its taxable income. Corporate taxes are due on March 15th of the year following the year in which the income was earned. You must accrue income taxes in the appropriate year. The adjusting entry is just like the entry we record for any other accrued expense. We increase or debit the income tax expense account for the amount of the accrual and decrease or credit income taxes payable for the same amount. The income tax payable is a liability account and is increased by credit. In our case, the taxes due are $780. In the real world, you will most likely need to calculate and record both federal and state income taxes. We already learned about the matching principle. The matching principle is one of the basic underlying guidelines in accounting. It directs a company to report an expense on its income statement in the period in which the related revenue are earned. Adjusting entries help us match costs with revenues, either directly by associating certain costs with specific revenues or through the allocation process. For example, allocation was used to record depreciation expense. Generally, accountants are most concerned about amounts that are determined to be material in nature. An amount is considered material if it may influence the decision of an informed user of financial information. When amounts involved are not material, many companies have established a policy of expensing the amount immediately. For example, small office supplies may last through several accounting periods. It is not cost beneficial, however, to record them as assets and allocate a portion of their cost to each month of operation. We normally expense the cost of these and similar items as they are incurred. We identified 4 types of adjusting entries. Each of them involves one income statement account and one balance sheet account. The effects of these adjustment types on the income statement and balance sheet are summarized here. Let's take a closer look at it. Type 1, converting assets to expenses. We already know that this type of adjustment requires a decrease or credit to an asset account and an increase or debit to an expense account. This means that there is no effect on revenue and liabilities. Expenses increase and assets decrease. Because expenses increase, net income decreases as expenses decrease net income. Owner's equity is also decreased as expenses decrease owner's equity. Type 2, converting liabilities to revenue. This type of adjustment requires a decrease or debit to liabilities and an increase or credit to revenue. Revenue, net income, and owner's equity increase. Liabilities decrease. Expenses and assets are not affected by this adjustment. Type 3, accruing unpaid expenses. This type of adjustment requires an increase or debit to expenses and an increase or credit to liabilities. Net income and owner's equity decreased because expenses are increased. Revenue and assets are not affected by this adjustment. Type 4, accruing uncollected revenue. This adjustment required an increase or credit to revenue and an increase or debit to assets. Revenue, net income, and owner's equity increased. Assets are increased. Expenses and liabilities are not affected by this adjustment. We reviewed just a few of the adjusting entries prepared at the end of May. Like the trial balance, the adjusted trial balance shows that the total of the debit balance accounts is equal to the total of the credit balance accounts. Make sure the books are in balance after recording our adjusting entries. In this example, total debits are equal to total credits of $22,200. That's all for today. Thank you for watching this video. I hope you found it helpful. Don't forget to like and subscribe so you don't miss future videos. I will see you soon.